All right. Hey there, Ojo Select Network partners. It's Jeremiah Taylor, Vice President of Real Estate Mortgage here at Ojo. Welcome to this month's masterclass. We've got an amazing guest for you that I will be introducing momentarily. You will notice likely that we're actually starting our webinar a little bit early because this is going to be an action-packed webinar today. And we're going to start on time and end on time. So let's let people filter in. As people filter in, let's play the game that we always like to play, which is go down there in the chat and tell us where in the US are you signing in from today. So go down there in the chat, click in there and just put where in the US are you chiming in from today. Oh man, all right. I see they're coming in. We're at almost 150 folks. We had almost 1,000 agents register for this webinar today. So Dr. Yoon, I'll tell you, you are quite the draw, my friend. I'm excited for this. All right, I see Tucson, Chicago, Long Island, West Palm Beach, Chattanooga, Tennessee, St. Augustine, Florida. Hey, for those of you joining, we're up to 160. My name is Jeremiah Taylor. I'm your Vice President of Real Estate Mortgage here at Ojo Labs. Excited to host our masterclass here for the month of October. As you're joining, pop in the chat there and tell us where in the country you're joining us from. I see that we have both coasts, Texas, California, Wildwood, North Wildwood, New Jersey, Ottawa, Illinois. Okay, that's a fun one. I like that because I immediately saw Ottawa. I thought we were going far north. We're at 190. For those of you that just joined, welcome to the October Ojo Select Network Masterclass. We've got an amazing guest. We're going to get it started right on time today. As soon as we hit 200, I'm going. We're at 194. Welcome, everybody. Again, it's Jeremiah Taylor, your Vice President of Real Estate Mortgage here at Ojo. We're excited for our masterclass. 198, 199, 200. All right, here we go. Hey, everybody. For those of you that just joined, welcome to our October Masterclass. It's Jeremiah Taylor with the Ojo team, and I am super excited to share this October Masterclass with you. What we're going to do is I'm going to go ahead and I'm going to turn it over to our amazing speaker. And for those of you that don't know Dr. Lawrence Yun, Lawrence Yun is the chief economist for the National Association of Realtors, where he oversees and is responsible for a wide range of research activity, including existing home sales, the affordability index, the home buyers and home sellers report. He also regularly provides commentary on real estate market trends for its 1.6 million realtor members. Dr. Yun creates NAR's housing forecast and participates in many economic forecasting panels. Among them, the Blue Chip Council, the Wall Street Journal Forecasting Survey, and the Industrial Economist Discussion Group at the Joint Center for Housing Studies of Harvard University. I cannot reiterate how excited I am to have Dr. Yun as our October guest. Dr. Yun, the floor is yours, sir.
Thank you, Jeremiah, for inviting me. Hello, everyone. I guess some of you out in the East Coast, good afternoon. Others in the West Coast, still morning. But the market has completely changed, beginning of this year. In fact, we released a new data this morning. I think it's in the media someplace, where it's showing that the pending contracts, the early indicator for closing activity, is down to 2010 levels on a monthly basis. I mean, first quarter was decent, so on the annual will be much better than that. But at least the latest monthly figure is the lowest in 2010. So market clearly has shifted. And the reasoning is very simple. The number of potential buyers who are able to get a mortgage is shrinking and shrinking with rising mortgage rates. So that has really began to impact the market condition. At the same time, difficult condition for people in the business. We know that there are some layoffs already occurring in the mortgage brokerage industries. Home builders are very cautious about the situation. They don't want to lay off their construction workers because they had faced a worker shortage, but at the same time, they're unsure about the future outlook. So we are in this uncertain moment. So what can we anticipate for the remainder of the year and certainly going into next year. When will the market stabilize and go up? Because we know that housing market is a cyclical business. It goes up, it goes down. During the boom, 2020, 2021, we had 200,000 people joining the Realtor membership because people thought, well, I want to join. But as you all know, it is a super competitive market out there, even in a good market. I know when I speak with realtors, they said, well, I know it's cyclical, but I do quite well even in a down market. So there are some individuals who always perform well. It's all about having the right business plan, serving your clients' long-term interests so you can get that referral recommendation constantly. So very important. All this discussion I can lay out better with the PowerPoint slide. So let me put that onto the screen and go from there. So again, I want to thank Jeremiah for inviting me to participate in this event. So hold 1 second as I put that onto the screen. All right, so we have it there. And let's move it along. So let's first look at the mortgage rate chart. Going back. This data is from 1990, just to show you more longer term perspective. I know many realtors have only started their business in the past 5 years, but this shows the long-term trend of mortgage rate from 1990, when it was 10% average mortgage rate. And then, as with many financial market variables, it goes up, it goes down. But if you notice, the trend overall has been downward sloping, meaning that it's down, down, down until this year. This year is sharply shooting higher. So what is the reasoning for steadily declining mortgage rate right up to this year? And the answer is simple. Inflation was a non-factor or diminishing factor. So when inflation rate is well under control, that means the lenders, mortgage lenders said, okay, I will lend you the money, and the money that is returned to me would have retained their value along with interest for profit. So the mortgage lender feel very comfortable lending at low interest rate when inflation is not a factor. But today, as you know, you go to grocery store, frustrating. You go to gas station, maddening. So high inflation is disrupting our daily habits, but it's also impacting the mortgage lender. Mortgage lenders are lending the money, and the money they are receiving back has lost value. So in this environment, only way to compensate for this rising inflation is to charge higher interest rate to compensate for the loss in value when the money is returned. The actual mechanism is, of course, the Federal Reserve raising interest rate to contain inflation. There's the mortgage-backed securities market, buying, selling, all that part. So end result is today we have high inflation and high mortgage rates. So when will the mortgage rate decline again? It will be when inflation is well under control. If inflation continues to be out of control, mortgage rate will either linger at this level or it will be even higher condition. I put that 3 red bar to indicate something called resistance point. It's a technical terminology that Wall Street players use. If you buy stocks and bonds or say oil futures and things like this, people just look at the chart and they try to assess whether it's hitting the resistance or breaking out of the resistance. So at times, just through momentum among Wall Street traders, it could be massive buying simultaneously or massive selling simultaneously, leading to a certain situation. So that 3 red bar, I put it as resistance point, and you can view it almost like a wall. It hits the wall and generally it retreats. So if you look at the lower bar, which is more recent, that lower bar, the mortgage rate is essentially about 5% or 4.8%. So in the past, it hit the wall, it retreated, hit the wall again, it retreated. But this year, it just went to the resistance point, and as if it didn't exist, it just punctured right through it. So once it is punctured, once the wall is broken, it makes a big gain until the next resistance point. Not a small gain, but a big gain. And we are at that critical juncture. We are at that second resistance point, right, essentially at 7% mortgage rates. If the 7% mortgage rate breaks down, the wall breaks down, then one is looking at the next level, which is 8.5% mortgage rate, something that we don't want to see, but that's a possibility if the wall breaks down. I hope it holds, because if it holds, what it means is that mortgage rate may actually go down again, maybe to 6.5%. So that's a possibility before going back up to 7% to test the wall again. But the 7% could be the new normal rate with possibility of some brief period when the mortgage rate could be at 6.5%. So critical juncture, watch carefully as to what's going to happen. Right now, it's just battling it out. Buyers and sellers of mortgage-backed security. Do you hold it at the wall, or does the wall break down? So we are at this critical juncture. First thing I do every morning is I look at the US 10-year Treasury yield. So blue line is the US 10-year Treasury yield, and the red line is the mortgage rate. You can see from the graph that two moves almost correspondingly, synchronized pattern. And so if the blue line rises, which 10-year Treasury constantly changes, that means most likely mortgage rate will be rising. So that's why I look at it. So US government, by the way, my office is in Washington, D.C. I am working remotely from home in Arlington, Virginia. But Washington, D.C., they're collecting in a record tax revenue right now. But they spend more than that, so there's a budget deficit. So how does the government manage that extra deficit? They borrow money. And the interest rate that the government pays is in essence the blue line. So government pays that blue line, and as you can see, mortgage rates are slightly above the government borrowing rate. But I want to see the direction just by looking at the blue line. But the blue line has its own resistance point and things like that. And again, is at that critical point whether it's going to break or not hold, but that's where we are. As you can see, there is slight spread between the red and the blue. And let me zoom in on that point. So this is the spread between the 10-year Treasury and 30-year fixed rate mortgage. So historically, the spread is only about 1.5 point or 2 percentage point difference. Put it simply, if the government borrows at 2% rate, then the mortgage rate will be about 4%. You just add 2 percentage point. So government is currently borrowing at 4%, which means that mortgage rate right now today should be 6% and not 7% under normal spread. But mortgage rate is 7%. Just consider your clients, how they would benefit if the mortgage rates were at 6% rather than at 7%. But we are at 7% because spread is larger than normal. I put that two little circles to indicate there are a couple of periods when the spread really widened than the normal condition. The first one in the middle of the graph, that occurred when Lehman Brothers went bankrupt back in 2008, right before the Great Recession, causing huge panic, potential bank runs and things like that. So the spread widened. The second circle is March 2020, when we were hit with COVID. People did not know what's going to happen. So that also led to larger than normal spread. In other words, time of panic, alarm, then spread widens. But look at today's spread. First, it's much larger than even those crises. And second, it's not anything panic or alarm. Of course, the economy is, teetering on recession. It's not right, but it's not like sudden changes like, massive bankruptcy by a Wall Street company or a COVID coming into the country. So very unusual. So we are talking to policymakers here in Washington to say, why is this occurring? Explain to us what may be happening. Is it possibly some market power among mortgage servicers leading to this condition? Or is the Fannie and Freddie, which are essentially government agency, are they doing something funny? So we want to know why, because it's clearly abnormal spread. If it's normal, your clients would be much better off. 6% mortgage rate compared to the 7% that we have today. But 7% is what it is. And what's happening? Because of high mortgage rate, home sales are sinking, sinking, and sinking from this year. This chart shows the pending home sales contract from early 2020, right before COVID. All the data are seasonally adjusted because we know that spring months are much stronger compared to winter months. So we adjust the data to sort of take away some of the seasonality. So you can view the red line as pre-COVID sales activity. Initially, lockdown, we're stuck at home, nothing could be done, therefore pending contracts crash. But once the economy reopened, what do you know? Consumers were eager to buy home. Home sales went way above pre-pandemic condition, and this was due to record low mortgage rate and also the remote work, especially for office workers. They were saying, oh, I'm working remotely, I need a larger space. Or people say, I don't have to live so close to downtown, I want to go to the next county, or even go to resort or vacation destinations and work from there. So we saw the housing market really boom in second half of 2020 and most of 2021. But beginning of this year, as the mortgage rate began to climb, home sales moved opposite direction of mortgage rate. So it's sinking, sinking, and sinking. And it's actually trending below 2019 levels, below pre-COVID year level conditions so far. In fact, that data point, the month of September, is actually the lowest since 2010, just that one single month. For the year as a whole, it's going to be something either similar to 2019 or maybe slightly below. But the monthly figure in September is actually the lowest September figure in over 10 years. One interesting part about current housing market downturn is the following. So you hear on the news constantly, home sales are down, maybe housing market will crash, things of that. If you have a client who still can qualify for mortgage at 7%, so they're still in the market, but they don't want to pull the trigger. They don't want to strike a deal because they are saying, look, I heard from the news that home prices could crash. Now, we've tried to provide a perspective to the media to say that we think that home prices will probably be stable, not a crash, stable. But there are other economists out there saying, well, prices could decline 20, 30%. So if you have a qualified borrower, they may still pull back because they don't want to buy a home in a declining market. And you need to show this chart. This chart shows the total inventory in the marketplace. When we had the price decline back in year 2009, 2010, 2011 period, the Great Recession, home prices plunged 30% nationwide. Some places in Florida and Arizona, it declined close to 50%. But those were the times where we had those funny, shady, risky mortgage, subprime lending, no income documentation, teaser rate, which quickly bloomed up much higher. So we had a mortgage market that simply imploded. Thankfully, today we don't have those mortgages. Mortgages that your client took out the past couple of years, very sound underwriting standards. They have to demonstrate income qualification, stay within budget. And even today, some people are taking adjustable rate mortgage. There's still very restrictive requirement to obtain a mortgage. So mortgages will not blow up. Another big difference is this chart, inventory level. Today, we are at only 1 million homes on the market. Back then, 4 million, 4 times more inventory. Simple economics, more supply, prices will come under pressure. Not enough supply, prices will probably rise. So we have a situation where we don't have enough supply. Now, with the home prices rise, I'm not sure because we don't have demand. I mean, we don't have supply, but we also don't have demand. So it's a sort of mixed picture at the moment. But the price crash of 20%, 30% simply will not happen. Only area where there may be some double-digit price decline, 10%, maybe 15% is in California, because home prices are super expensive in California, as everyone knows, and changes in mortgage rate has a bigger impact in expensive markets. Percentage-wise, it's all same across the board, but if you live in Cincinnati, recent changes in mortgage rate may mean $300 additional monthly mortgage payment, say $300. But if you are living in San Francisco, you are looking at $2,000 increase in mortgage payment. So that's a shocker. So you see much larger decline in expensive markets. Consequently, you may see some price decline, either high single digits or even double digit price decline in California market. And they have another thing that's occurring in California. People are leaving. So people are leaving California, which is not a good trend. So if you are in a place where people are moving in, you are not concerned. But if you have a place where people are exiting, that is certainly a concern. But broadly speaking, low inventory means that home prices are getting support. Therefore, if someone can qualify for a mortgage, they should not be too concerned about any price crash. Prices next year, I think it will be either -5% or +5%. I'm not sure which direction it will go because we certainly have lower demand, but we also have lower supply, which will provide support for prices. Here's another indicator that the market is on very healthy ground. The number of homes that are going through foreclosures or requiring a short sale. Short sale is when you sell a home, so you receive the dollars, but you cannot pay off the mortgage because mortgage balance is higher than the price. So you have to get a bank approval, something called short sales. So those are distressed property sales. Today is almost non-existent. To be precise, it is 2% in our latest data. Last year, it was 1%. So it's moving from 1% of last year to 2%. Some people in the media may say, oh, that's a 100% jump, doubling in the force. But look at this graph. It's almost non-existent. It's definitely not the case of 2010 when it was about 1/3 of the market or 40% of the market. So homeowners are in fine condition. In fact, they are quite content. In fact, they may be smiling. Something that you may want to do, recontact your client of the past 2 years. Just say, hello, how are you doing? Because they are happy. They locked in that 3% rate. Furthermore, after purchasing, they saw their home values rise. So that's wealth gain. So they're quite content, and you want to associate that happiness with you. So just by contacting them, they will quickly be reminded, oh, I'm so happy, and it was because of my realtor who helped me buy this home. So that in the future, they can recommend friends, business colleagues over to you because they're in a happy mood, and at least you want to, at least have a little presence with that happy mood. Very little people who are unhappy, meaning foreclosure or short sales, only 2% of the transaction currently. Here's what's happening in the marketplace when I check the MLS data across the country. Not every MLS, but a good portion of the MLS across the country. What we are finding is, not the table, just looking at the headline, 51% of the homes are being sold right at list price or slightly above, which is quite unusual in this housing down market. So you are saying home sales are down, but how is it that one can still get a list price? And the answer is there is not that much listing. So just consider someone who was involved in those intense multiple offers last couple of years, they got outbid by other people. In fact, if you had a client who had a VA loan, Veterans Affairs mortgage, or FHA mortgage, they almost did not have any chance to compete last 2 years. So when they see a new property coming onto the market, It may be the only one in that neighborhood that they were focused on. They said, I want to buy in this neighborhood, and it's only one listing, and consequently, they want to submit a bid, but there are others also doing it. So even in this declining home sales market, due to the lack of inventory, some multiple offers are still happening. Definitely not the intense multiple offers. Maybe some homes are not even getting any offers, but there's still some occurring. So 51% of the home being sold at list price or slightly above. But 49% are conceding on price. And it depends on the days on the market. So let's go to the very last column on the right-hand side. So right-hand side shows 4.6, 5.2, 6.0%, and down the line. So what is this? This is the home that actually closed, went to the settlement. So if the home had a price reduction and home was listed and they found a buyer, contract signing within the first week, price concession was 4.6%. The negotiated price, 4.6%. If the home was on the market for 30 days, price negotiation was 6.8%. If the home was on the market for 120 days, very long time, price negotiation is essentially 14.9%. So just consider $1 million listing, you are closing at $850,000 if the home is staying on the market for a long period. I mean, you sort of know that. Longer the days on the market, more price shavings. What you may not have known is this is what the realtors across the countries are actually doing. So these are the actual figures on what's happening. Maybe every neighborhood will be slightly different from this, but this is what the actual data from the MLSs. If you look at the middle column, is for pending listing that did not go to closing yet. Because if you get a pending contract, don't uncork the champagne bottle. It's not time to celebrate. Why? Home inspection is back. Last year, home inspection, people waived multiple offers. Only way to win was waive the home inspection. But today, people are insisting on home inspection. And home inspectors who have not been busy for a while, now they are hired to do the job. They are finding 101 things wrong with the house. And therefore, you have to do a second round of price negotiation. So the middle column, pending versus sold listings, you see, in generally speaking, little less of a price concession to indicate that in order to get to the closing, you may have to do a little more price concession. And the first column is just the active listing that did not even get a contract. And the price declines are much more minimal. And maybe you can say, well, they're not getting any contract because price decline is not sufficient to attract buyers. So anyway, maybe this table you can utilize in some way, but certainly shows that you don't want to misprice home from the get-go. It's going to linger in the market. And if it lingers on the market, expect price discounts. Let me now flip to the economy, talk about the economy. A lot of discussion about whether we are in a recession or not. So let's look at GDP, which is the broadest measure of the economy, total production that we do in the country. Everything from dental service to automobile production to cutting the lumbers, all the stuff that we produce, how are we doing? And the beginning of the chart shows the lockdown impact. We were stuck at home, economy crash. Once the economy reopened, tried to recover quickly, and then it was positive until this year when it turned negative, slightly negative. Yesterday, new data came out and it was blue, meaning that it would turn positive again. But still on a shaky ground, because the next quarter could again be negative. So we don't know which way the economy will go, but you can say it's on the edge of potentially declining into a recession. If you don't believe that we are in a recession, look at your retirement portfolio. It's definitely indicating as such. Whether it is a stock market, I know that more and more people have cryptocurrency in their retirement account, everything is sinking, so your retirement account is diminished, evaporating. Another indication that something is not right about the economy. But the job market is one area where things are still holding on nicely. In fact, this is total number of payroll jobs. Payroll jobs are not people on commission income. Realtors are on commission income. Their income rises, falls, fluctuates greatly. But people who are receiving W-2 statement salary, steady income, this is how many people are receiving W-2 statement across the country. The number of jobs right before COVID, then when COVID lockdown hit, 20 million job losses, but with each passing month, more jobs, more jobs, more jobs, such that today we have record number of Americans receiving W-2 statement salaries. But in a sense, you would say, every year we should have record high because we are in a rising population country. With more people in the country, we should always have record high employment. But we are only returning just now after all this COVID disruption that took place. Here's an interesting data point. At the beginning, Jeremiah mentioned where you're from, and I saw all this, Boulder, Colorado, Bloomington, Indiana. People are just typing in many places. So you can hone in on your area. So this shows payroll job growth in the latest versus right before COVID, March 2020. So, for example, Florida, easy to identify, is showing 5.6%. What does that 5.6% mean? It means 5.6% more job in the state of Florida today versus right before COVID. So huge job creation in Florida. Same in Texas. Green is good. Then you see a sort of darker red colors. Like Alaska is the dark red, Vermont is dark red. They're down significantly. And then orange is down, or darker orange are down. Maybe the yellow is barely positive. So you see your state, how it's performing. One thing to note is the following. State that reopen its economy sooner, like Texas, Florida, Georgia, Utah, they're doing well because they had more chance to create jobs. State that had a long lockdown, like Michigan, Pennsylvania, and New York, they're still down because of the lockdown impact. In fact, Pennsylvania had a very restrictive condition for realtors. They said you cannot do open houses. I mean, realtors were screaming, what do you mean we cannot do open houses even when the economy was reopened? Because the governor of Pennsylvania said, no, that's dangerous. You don't want to do that. So Pennsylvania was the last state to be able to do an open house. So it took them quite some time, but they're down consequently because of that longer lockdown. Another thing to note is the following. Oil producing states are down. Alaska is negative. North Dakota is negative. Wyoming is negative. New Mexico is negative. Louisiana is negative. So anything involving oil is down. Texas is an exception because Texas is so well diversified. Oil is no longer their economy anymore. So oil producing states are down, which means that we are not drilling that much. And what happens if you don't drill? That means you are suffering at the gas station. So when you see high oil prices, it's because America is not drilling. America is going to Saudi Arabia to say, please produce more oil, which in fact we can say, well, why don't we drill more in America? But given that we are not drilling here in America, oil prices are high. And as I mentioned at the very beginning, high inflation means high mortgage rates. So one of the causes of higher mortgage rate today, you can say, is because high gasoline prices. All that filtering in, and we have slightly higher mortgage rates, which harms the housing market. Green energy, of course, is very important, and it will be for the future. But we have to recognize green energy is less than 10% of our energy. 90% is carbon. We cannot simply throw away the carbon energy right away. So we have to see what the right balance is. Why are we begging Saudi Arabia to produce more? I mean, European countries are going to Africa to say produce more oil rather than producing in Europe. So it's kind of a little strange condition. But right now, you see which states are up, which states are down, and also why oil prices or gasoline prices are so high, especially knowing that realtors drive much more than the general population. Let me just go to this. Now, for the consumer sentiment about the economy. So a simple question about how do you feel about the economy? I guess there's various sets of questions. How is your retirement portfolio? How is your job? Do you feel secure in your job? All this type of question, according to University of Michigan survey, it's a national survey, and they come up with this index. And the index is implying that Americans believe the US economy stinks right now. It's very low ratings. So people are not feeling good. Again, daily reminder at the grocery store, at the gas station, and their retirement portfolio. So they look at it and they are saying, nope, things are not right in the US economy. Here's even an uglier data. Simple question by Fannie Mae to Americans. Is it a good time to buy? Very simple question. And Americans are saying, nope, it's not a good time to buy. Why? It could be much higher mortgage rates. It could be lack of choices, meaning tight inventory conditions, still ongoing tight inventory condition. It could be that they are concerned about the economy, direction of the economy. So people are saying it's not a good time to buy. The only caveat to this graph is the following. What people say and what people do not necessarily match up. So people may be saying this, but if the condition is right, they may actually want to buy. How do I know that? Well, look at the middle of the graph. Year 2020 and 2021, real estate market boom. Yeah, what did the consumer say? They said, well, same thing, same thing, same thing. Consumers did not say it was better time to buy, yet we know that real estate market boom. So what people say and what people actually do not necessarily match up, which means that if the mortgage rate for some reason decide to go back down again, hit that resistance and retreat somewhat, and then inventory shows up, maybe people want to strike a deal. So that's clearly a possibility. So just because people are saying it's not a good time to buy does not mean you should just be in hibernation. You should always be ready because what people say and what people do not necessarily match up. I'm down to my next to last slide. Inflation is terrible. It's hurtful. It's frustrating. But is there any benefit of inflation? And the benefit is unexpected inflation causes a redistribution of wealth. And debtors benefit from that. How does it work? You're holding on to a certain amount of debt, but if there's an inflation, it is less heavy than before. To illustrate this, let's run the number and something that, again, you may want to use with your clients. So let's say a person takes out a $350,000 mortgage today at today's 7% mortgage rate. Principal and interest would be 2,329. Excluding property tax, excluding escrow and monthly payment and things like that, just mortgage interest payment, 2,329. Next year, same thing. Next year, same thing. Middle column, I'm using a household making $80,000 a year, which translates into monthly salary of $6,667. According to the data, currently people receiving W-2 statement salary, on average, their salary is rising 5%. 5% increase in salary is insufficient to catch up with inflation because grocery bills are rising at 8%, and overall consumer prices are rising at 8%. So 5% increase in salary does not mean improvement in standard of living. You're only trying to barely catch up. If you are receiving Social Security or your parents, they will receive 8% cost of living adjustment next year. So income is rising. I mean, it's not an improvement in standard of living, it's just trying to catch up with inflation. So when there is an inflation, people's income rise somewhat. So 5% growth this year, So income becomes 7,000 next year. And then you see on the middle column steadily rising, assuming that this is the case. We have high inflation for a prolonged period of time. And you go to the last column, how much is the mortgage debt payment in relation to people's income? And it's steadily diminished. So income is rising while debt payment remains the same. So it's becoming less heavy over time. So if we have a high inflationary period in upcoming years, this will be the table, something you want to relay to any potential clients. But let's do another scenario. Another scenario is following. What happens if inflation dies away? Inflation becomes a non-factor 2 years from now. Then mortgage rate would not be 7%. Mortgage rate would be 4% or 5%. And what do? You refinance into those low rates. So you win either way. If we have high inflation, you have this chart. And also the rents are constantly rising with inflation. So if you are a real estate investor, you know you are collecting higher rent. But if inflation disappears, people can always refinance into the lower rates. I mean, I purchased my home, or my wife and I purchased at 8.5%. That's the one best financial decision ever in our life, because home values increase and later we refinance into lower interest rates. So if inflation persists, use this table. If inflation dies away, you can always refinance into low rates. My final slide is the forecast. 2019, this is a national forecast. It was, in hindsight, kind of boring year. No increase in sales, prices increased 4.9%, nothing exciting. Then 2020 became exciting for real estate. I know COVID really disrupted our lives, but real estate became exciting. Increase in sales, increase in prices. 2021, momentum continued, even more exciting. But this year is a transition year because of high mortgage rates. Home sales, once the December numbers are in, will be down about 15%. First quarter was decent. Second quarter, a little light. But the third quarter is really ugly. We are seeing about 30% decline in sales activity. Fourth quarter will be equally ugly, but you combine all year, it's going to be down 15%. Home prices still above last year. So dollar volume is only declining, roughly speaking, for a large brokerage, only in the single digit after a very robust double-digit gains of the past 2 years. Next year, assuming 7% mortgage rate is the normal, there will be still further decline in sales, but the home prices will still hold on, meaning that probably it's not going to be +1, but it's probably going to be either -5 or +5. I'm not sure exactly where. But it will not be -30 or +30. Then in 2024, I hope the mortgage rate begins to decline, and home sales are always sensitive to changes in mortgage rates. It always moves in the opposite direction. So in 2024, maybe we have the inflation better under control, mortgage rate decline, and once that happens, home sales return to the growth condition. But this year is transition, and next year, somewhat calmer market, but don't expect any robust activity next year. So thank you very much for listening. And again, I want to thank Jeremiah for inviting me to participate.
Thanks so much, Dr. Yoon. I know that you've got to drop here in about 10 minutes, and we will get you out of here on time. We've got a couple great questions in the chat. So the first one I see here is, you talked a lot about the housing market. How do you feel specifically about the rental market? Do you see a softening in rents, or do you see rents continuing to climb over the next few years?
We look back at the early 1980s when the Federal Reserve was very aggressive in raising interest rates, just like in a sense, something like today. During that time, mortgage rate actually went up to 18%, believe it or not, 18%. And you would think that, okay, what happened to home prices? Home prices actually held on. It actually increased. And why did it increase? Because rents were rising. So right now, if you are real estate investors, you have had a good run. Rents rising, real estate prices at least having risen strongly the past 2 years. So you came out very fine. But now with mortgage rate much high, you see home sales declining, which means that those potential first-time buyers cannot buy. So what do? They have two choices: move back in with their parents or renew their lease and rental demand. So in a sense, rental demand will still remain strong. Only caution is the following. Apartment building activity right now is at a 40-year high. It's not completed, it's still under construction. So there's a large apartment construction activity going on across the country. We know that the rental demand will be strong, but the supply will soon come onto the market. So be mindful of that condition.
That's great. How about the luxury market? Do you have any thoughts specifically on how the luxury market is impacted and if it's any different than, kind of the average housing market?
The luxury market is more interest rate sensitive compared to the middle market. And again, the California market is suffering more than rest of the country in terms of decline in sales. But California, when you say luxury, you are looking at $1 million home that is a small townhouse, so it's a little different. But if people think about more luxury, right now the luxury market is getting hurt because of the downturn in the stock market. The wealthy individuals have quite a sizable wealth with their stock market, but with the stock market tanking, that's also holding back. But I will say the following. We all have two cars in our garage. Two cars are very normal for American families. I think having two houses, vacation houses, will become a very normal thing for American families in the future, extended families. So easily visualize. Work from home environment, returning to office 5 days a week, it will simply not happen. So there will be many opportunity to work from home or work from vacation home even better. So have a vacation home. I use it this week. Next week, my sister uses it. Following week, my uncle uses it. So within the extended family, I'm talking about the middle class family, not the super wealthy. Within the middle class family, extended middle, they will have a second home. So that will become very common. So I am very optimistic about the resort destinations. I know that it's temporarily declining just like every other markets, but I think it has a better chance of pickup and long-term growth in this market.
Very, very interesting. There's a couple questions on the supply side, and I don't know how willing you are to comment on policy. One is specifically on Powell's policy going after tamping down demand versus focusing on increasing supply. So feel free to go there or go to, where do you see supply going in the next year or two?
No, we did a study, a research study, which showed right before COVID hit, we were talking to policymakers to say we are in a major housing shortage. We are short by about 5 million housing units in America. Because we have population growth, we have job growth, but we're not producing enough housing. So it's going to cause a major problem. And when the COVID hit, again, the real estate benefited from that. So we had an intense housing shortage at that time. It looks like we don't have that situation at the moment, even though inventory is not there. But once the mortgage rate slightly declines, I think we will again face the acute housing shortage situation. So we have to address the supply. Now, anything that obstructs home builders from building, whether it is a excessive regulation, I mean, some of the home builders say, look, all this strange regulation, it's only a rain puddle, but because of the rain puddle, we cannot dig the ground because of environmental regulations. It doesn't make any sense. So we need to consider what the right balance is, or even consider some rezoning conditions, especially where there are large cities, mass transit, maybe next to the mass transit, they could build more condominiums part rather than just single family homes. So we need to produce more, but often, especially now for more middle income housing, nurses, police officers, they live in the community, they should be able to buy, but in some community, they simply cannot. So the only way to make the numbers work is to actually subsidize the construction of those homes. Is it going to be part of the infrastructure spending bill where they carve out to say, yeah, let's build more housing, so provide that extra money, or maybe tax credit, provide more tax credit incentive to build more housing, because we need to address this long-term situation on housing supply. And I like the question from on this part, because what Federal Reserve is doing is trying to chalk off demand. in order to balance the market. I don't like that. I'd rather see an increased supply. Let the demand be what it is, but increase supply to balance the market. So that would have been much preferred outcome.
I love it. Last question. Talk to us about investor activity. Is the U.S. market still a destination for international investors, and where do you think we go with investor activity in the coming months?
Domestic investors have been very steady at roughly 15-20% of the market. But regarding international investors, they are unable to come in easily. First, last couple of years, COVID restriction prevented, but now people can come in. But now they're saying U.S. dollars is super expensive, and therefore any say British who want to buy property in Orlando, or say Chinese or people from Hong Kong who want to buy in California is super expensive because of the U.S. dollar strength condition. And I know you say, well, dollar is strong. Why come? I don't feel that strength when I go to grocery store. People don't feel that. But for international buyers, they are saying U.S. real estate is very expensive. So a little caution among international buyers at the moment.
That's great. Well, Dr. Yuen, I can't tell you how much I appreciate this. I have an entire page of notes here next to me of things that you just shared with us. All of the agents, we've gotten hundreds of comments here, how appreciative they are. I know you have another commitment, so we will let you go, Dr. Yuen. Thank you again. For those of you on the webinar that are agents with the Ojo Select Network, I actually have 4 quick updates for you, so stick around for 90 seconds, but Dr. Yuen will let you go. Thank you, sir. All right, so Ojo Select Network agents, I'm going to give you 4 quick tips on how to win with Ojo, and you're not going to want to miss with these. Number 1, when we send out a lead offer, whether or not you service that lead, that area, that price point, that budget, that language, just respond. There is no penalty in our network for declining a lead. In fact, we give you a boost if you are quick to respond. So when you get that text message, open the phone, tap on the link, click accept or decline, and then tell us explicitly why you're declining. This isn't in my area. I don't work this price point. The more data you give us, the faster our algorithm can learn so that we send you more leads that you want. The key is you have to respond. Now, I will tell you, if you don't respond, if you don't open, you don't click, you don't give that feedback, you do get penalized for that. And if you do it consistently, you may find yourself in a world where you may stop getting lead offers. So make sure you open, click, accept or decline. Even if you miss it by an hour or a day, still interact with it. That tells us you're interested, you're engaged. Number 2, what you're seeing is we're running some experiments on our side where we're finding that certain consumers that our algorithm thinks are more likely to transact, we're speeding up that connection to get them to an agent, which means we are having you call them immediately as soon as they come in, rather than us getting in the middle and trying to make a warm transfer on a very small number of consumers. What that means is you're going to see in that lead offer, it's going to say there's a new lead available and you need to call them. As soon as you claim that lead, you're going to hit click to connect. It's going to dial outbound to them. And our technology is listening for that signal. Now our teams are going to follow up with those leads as well. So if you don't hit that click to connect button and do the thing in your Ojo agent tools, it can create a weird experience for the consumer because you may already be talking to them and now we're also trying to call them. So make sure when you win a lead and it's not a warm telephone transfer, you always go in your agent tools and click to connect, okay? Third thing, some of you know this, some of you don't. Once after we connect a consumer with you, we have an entire team of concierges that are dedicated to helping you cement that relationship. So within a day of us introducing the consumer to you, then what's going to happen is we're going to send the consumer a text, an email, we pop forms on the website, we call them and we say, hey, how's it going? Did we make a good match with the agent? And a large percentage of the time, the consumers say, yeah, thumbs up, it's going really well. Guess what? We listen to that signal. So I know the last time I took my truck in for service, my service advisor says, hey, listen, Ford's going to follow up with you. They're going to ask you how I'm doing. Anything less than 5 stars is considered failing in my book. So if something's wrong, please let me know how to solve it. If I was an agent in the Ojo Select Network, I would be coaching my clients to the same thing. Hey, if Ojo follows up with you to find out how I'm doing, anything less than a total satisfaction is failing in my book. So please make sure you let me know if there's something that I need to resolve. I see a great question about how do we get that feedback? At the moment, the feedback is just like, is it going well or is it not? If they say it's going well, we really don't do anything with it. In the future, we will put that in agent tools. If we say it's not, our concierge team is going to find out why, and they're going to call you, text you, email you. The most common thing, single most common thing we see every day is agents promise something to a customer, they get busy, and they forget to follow through. Our concierge team over 150 times a day reconnects agents with consumers where the consumer's like, yeah, it's been a few days. The agent said they would get me XYZ. I haven't heard back. That is one of our biggest opportunities as agents, is to follow up and follow through. The good news is here at Ojo, we've got a team of people behind you trying to make magic happen, because like even the best agents get busy. We get it. We want to help you always show up in the best light. So when you hear from a concierge and they're reconnecting you, run with it, nail it, do it. Last one, make sure you use the snooze feature. If you're going to be unavailable for an extended period of time, more than a few hours or a day, go right in those Ojo agent tools, click snooze. That'll stop the lead offers coming to you, because like I said, if you don't respond, really, we're looking for you to respond within like 90 seconds. If you're not going to be able to respond within an hour, you should probably snooze yourself. The great news is this, and the product team is, I know some of them are on the call. I love you guys. I'm going to promise something. We are working on updating that snooze feature so that you'll be able to set a time in the future to unsnooze. Expect that to come in the future. But make sure you're snoozing anytime you're going to be unavailable. Parting thought, Ojo Select Network, you all are crushing it. It is amazing to see that in the headwinds of everything that Dr. Yoon shared with us, we're seeing more agents have more success with more consumers than we've seen any time in the history of our company. And what that means is that, look, the market is slowing down, properties are sitting. And the problem we had before is we had consumers that wanted to buy houses and there were no houses for them to buy. Today, we still have consumers that want to buy houses and there are plenty of options. So we're going to continue doing our part. We're working hard every day to grow our lead volume so that we can get more great consumers in the hands of our great agents. We appreciate you. We're going to continue to try and push and find ways to add value to drive more leads. Make sure you join our social communities, Facebook, LinkedIn communities, follow us on YouTube, engage with our training, keep showing up to these webinars. We love you. We appreciate you. You are what makes Ojo amazing. And Julie's going to close us out with a parting thought.
One more thought for, I saw so many of you asking if you were going to get the slides and will you get a recap? Absolutely. We will send out a recording. We will send out a recap. Make sure if you want more content like this from Dr. Yoon, and you want more market updates from him, follow him on LinkedIn. His content is amazing and he gives updates like this all the time.
Awesome. Thanks again. Y'all have a great weekend. Appreciate everybody here today. Go get them.
Thanks, everyone. Bye.